Welcome to MarketTamer.com. We're looking at the futures on Monday morning, and we see slight pullback here in the Dow, the S&P, and the Nasdaq. The Dow is down 103 points, the S&P down 13, and the Nasdaq down 20. If this was 2 years ago, we might be concerned about these pullbacks. Certainly a pullback in the Dow of 100 points used to be considered big, but given the movements of the past year where we've seen 200-point days, 300-point days, 400 and onwards, this is not really a significant pullback, so nothing to be too concerned about. That is emphasized to a greater extent here by looking at the chart of the S&P 500. We've had a very big surge over the past week here. About a week or so ago, I mentioned that we might see a continuation of this rally for a period of up to 10 days. And certainly the past 5 have been quite bullish. We've had 3 up days and 2 down days, but the 3 up days have been very substantial, 1, 2, 3, and the down days have not really tested anything other than the 5-day moving average. If we look to the March low, we've seen this huge surge higher. We've seen the move up, but throughout this move up, we've seen corrections, and those corrections have been down to the 20-day moving average. So that tells us that even though the market is really quite significantly higher, substantially above its 20-day moving average right now, which is holding up somewhere around 875, and the market is, well, today it's going to drop back. In fact, let's just return back. We see it's going to drop about 13 points at the open, so that would tell us that it will drop from the closing price on Friday of 929 down to about 917-ish. And so that's still right around maybe its 5-day moving average, slightly above its 5-day. That tells us everything's still bullish. Even if we get a correction beyond that down to the 20-day, that's not cause for concern. However, what is cause for concern is a resistance level right around this 925, 930 region. If we see that the market starts to falter right around this level, and in fact not only tests the 5-day and the 20-day, but starts to close below the 20-day, that would be the sign that this current rally is most likely ending. With that said, we also looked about a week or so ago at Apple, and a few questions had come in regarding the outlook of Apple. Where was it headed? Was there a way to take advantage of a bearish trend? And what I mentioned was, at the time, we could possibly take advantage of a 140, 145 bear call. Now, as it turns out, the timing on that video was absolutely perfect. And certainly there's always an element of luck when that happens. But it turns out that we were talking about Apple right around the peak here. And so it has dropped back. And as it turns out, with just a few days left to expiration, those options at 140, 145 are not worth much at all. So it's one of the nice aspects of credit spreads and bear calls that if the move goes in your favor right away, you can actually make money very quickly, as happened here. In fact, as the market moves up and then you enter a bear call and then it starts to move down right away, there's a very strong effect against the short call, and so you can make money very rapidly, which is what happened. With that said, because there's only a week to go to expiration, it's possible to simply close out those options and take profits. Of course, none of what we discuss here constitutes a recommendation to buy or sell a security, but what we do is throw out possibilities to enable you virtual trade these positions and enhance your own trading skills. And if you'd like to learn more about how to do that, please come on over to MarketTamer.com.